All right, let's talk about today, Friday, February 20th, 2026, because what we saw in the Asian financial markets, well, it was like watching two completely different worlds unfold. Today, we're going to break down exactly why. So get this. On one hand, you've got South Korea's KOSPI index just blasting off, up over 2.3% to a new record high. I mean, wow. But then, at the very same time, Hong Kong's tech index, the HS Tech, completely nosedived, dropping almost 3%. Now, here's the thing. These two usually, they kind of move in lockstep. So seeing them go in totally opposite directions, well, that's the big puzzle we need to solve today. So what in the world created this massive gap? I mean, how is it possible for one market to be popping champagne for an all-time high, while another one, just a quick plane ride away, is bleeding red ink? That's the central question, and we are going to get to the bottom of it. Okay, here's our game plan. First, we'll dig into the hard numbers. Then, we're going to unpack 5 key theories to explain that Korean surge and figure out the story behind Hong Kong's fall. After that, we'll look ahead with some specific predictions for March, and we'll wrap it all up with a solid, quant-based strategy for dealing with a market that's this divided. First up, let's take a forensic look at those closing numbers. We've got to start with the facts, with what actually happened today. And this table, well, it just lays out the whole story perfectly. Look at the KOSPI, closing at a historic 5808.53, a massive 2.31% jump. But here's where it gets really interesting. Take a look at the KOSDAQ, Korea's market for smaller companies. It actually went down. See that split? That's a classic K-shaped divergence right there. And of course, over in Hong Kong, the H-Tech index got hammered, with tech stocks leading that 2.91% plunge. Okay, so now for the big question, why? To really understand the KOSPI's historic surge, we're not just going to guess. We're going to bring in 5 expert witnesses, if you will, 5 powerful economic theories that each shine a light on a different piece of this puzzle. Our first theory is something called Gunter Duke's over-optimization. The idea here is that investors have kind of stopped calculating the individual value of companies. Instead, they're all piling into one single grand narrative, AI's supremacy. And the result of this? It's incredible. A full 40% of the KOSPI's entire value is now concentrated in just 2 semiconductor giants. It's a market-wide frenzy, all focused on a single idea. Theory number 2 is what Seyfedin Ames calls low time preference. Basically, it means prioritizing long-term value over those quick short-term gains. This way of thinking frames the rally not as hype, but as a reward for these massive long-term investments in next-gen AI memory, stuff like HBM4. And at the same time, that 2.5% interest rate is acting like a filter, weeding out weaker zombie companies and pushing capital towards the most disciplined, future-focused firms. Then we have our third theory, Ken Fisher's famous wall of worry. You've probably heard this one. It says that the strongest bull markets actually climb when there's pessimism in the air, not optimism. And the key piece of evidence for this? Retail investors, the everyday folks, are actually selling Korean stocks right now. They're moving their money to the US market. Paradoxically, this is a classic bullish sign that the smart money is driving this thing, and it's got plenty more room to run. Next up, John L. Casty's concept of social mood. This theory suggests that a collective feeling, a vibe, can actually become a tangible force in the market. And right now, there's this powerful sense of national pride in K-Tech, It's being fueled by really strong export news, and it's creating a positive mood so strong that it's literally overpowering significant selling from foreign institutions. It's the power of collective optimism in action. And our final theory, from Edward R. Dewey, is all about cycle convergence. This one suggests today wasn't random at all. Nope. Instead, it was predictable. The argument is that what we're seeing is a rare convergence of 3 major economic cycles: the stock cycle, the credit cycle, and the semiconductor cycle, all hitting their peak at the exact same time. So this isn't luck, it's just the market's natural rhythm. Okay, so we've got 5 really solid reasons for the KOSPI's incredible surge. But now we have to flip the coin. We need to investigate the other side of this K-shaped day, the story behind Hong Kong's sharp fall. And this slide just lays out the contrast perfectly. It's a mirror image. Korea's narrative is all about AI supremacy. Hong Kong's is AI fear, this deep worry that new tech will disrupt and maybe even destroy older business models. Korea has K-tech pride. Hong Kong is dealing with ongoing geopolitical risk, which always makes global investors nervous. And that, of course, drives the third factor, capital flight, as money runs for what it thinks are safer havens. It's literally optimism versus fear. So we've analyzed the why. Now it's time to shift gears from the present to the future. The source report actually uses its quantitative models to make some very specific predictions for the month of March. You can see the model's forecast really extends this whole theme of divergence. It predicts the KOSPI is going to keep climbing right through March, while the KOSDAQ will continue to lag behind. But what's really interesting here is the forecast for Hong Kong. It's actually predicting a significant rebound from today's lows. But out of all the numbers, this is the one to remember. This is the big one. The model's target for the KSOPI by the end of March is 6,250. To put that in perspective, that's another 7.6% of upside from today's record close. A pretty bold prediction, but it's based on all those factors we just talked about. So the big question is, given all this analysis and this forecast, how do you actually navigate a market like this? Well, the report outlines several quantitative strategies to do just that. The main strategy is designed to profit directly from this polarization we're seeing. It's a classic pair trade. You go long on KOSPI 200 futures to capture the strength of those big winners, and at the same time, you go short on KOSDAQ 150 futures to hedge against the weakness in the smaller companies. The report also suggests a couple of other strategies, more for risk management. The first is called volatility rebalancing. You use statistical models, like GARCH models, which are designed to forecast volatility, to figure out the best times to build up your cash position so you're ready to buy any potential dips. The second is time preference allocation. This connects right back to that theory we talked about earlier, balancing those high-growth, long-term assets with safe haven assets like gold to protect your portfolio. And this quote, I think, really captures the report's final conclusion. Today's record high isn't some peak to be afraid of. It's actually the starting line for a whole new market paradigm, one that's driven by technology and by capital discipline. Which leaves all of us with one final and really critical question. We've laid out the data, the theories, the forecasts, and the strategies. So now, the question is for you. In this new hyper-polarized market, what is your strategy?